Welcome to D-Risk, a podcast where we provide a no-nonsense analysis of stocks. Today, we're diving deep into, well, a really interesting question based on our research stack. Can a company actually run out of good news? And we're looking at NVIDIA here using data from October 29th, 2025. It really feels like we're seeing this huge clash between explosive news and maybe market reality.
Yeah, and it's happening against this backdrop of, frankly, market confusion. I mean, you look at pre-market futures, they're green, NASDAQ leading the way.
Right.
But, and this is a big but, U.S. consumer confidence just dropped. Again, third straight month, lowest since April.
So positive momentum clashing with some gloomy economic signals.
Exactly. And NVIDIA seems to be right in the middle of that tension. It's the perfect case study.
Well, that context definitely makes the news coming out of NVIDIA even more staggering.
Yeah.
Our research highlights that recent conference they held. The announcements were just massive.
Huge. They rolled out this dizzying list of partnerships. Automotive, pharma, cybersecurity, you name it.
And they didn't stop there. They projected, $500 billion in revenue from next-gen chips? That number is just, wow.
It's astronomical. And they backed it up with specifics, right? Like $1 billion into Nokia, building that massive AI supercomputer with Oracle and the government.
Yeah, real projects, real money.
So no surprise, analysts loved it. Our research shows 92% of the analysts covering them, that's out of 64, rated a buy or strong buy.
Okay, Wall Street loves it. But here's where, for me, it gets really tricky. The stock's trading over $200.
Right. But the valuation models, they're telling a very different story. A much more cautious one. Based on free cash flow, the estimated fair value we're seeing is around $172.
Hold on. $172, even with those huge revenue projections.
Yeah.
How does that work? I mean, FCF is usually pretty conservative, right? Based on actual cash, not just promises.
Exactly. It's about the cash the business is generating now or reliably expected soon. And if you look purely at earnings-based valuation, well, that number drops even more.
How much more?
Down to about $89.
$89. Okay, that is a disconnect, a massive one.
That's the core conflict right there. The market seems to be pricing in years, maybe decades, of perfect execution and growth.
Well, the fundamentals, the sort of here and now numbers, suggest it's, significantly overpriced. Is it revolutionary growth or just classic hype?
So to figure out which side is winning this tug of war right now, we need to look at sentiment. What's the crowd doing?
Are they buying the hype?
Completely, utterly. The options market is just screaming bullish. Get this. The put-to-call ratio is 0.32. Basically, for every one bet the stock might fall, there are roughly 3 bets that it's going higher.
Wow. So very little demand for protection, lots of demand for upside.
Precisely. And short interest, forget about it. It's tiny. Less than 1% of the available shares are shorted. Almost nobody is willing to bet against this thing right now.
Okay, so sentiment is max bullish. What about the technicals? Does the price chart back this up?
Oh yeah. The momentum is undeniable. Both long-term and short-term trends look pristine, decisively upward.
And volume confirms this. Big money involved.
Volume confirms it, that recent surge. You can see institutional money piling in, no doubt about it.
But there's always a but, isn't there?
Always. The one major warning light on the technical dashboard is that the stock is getting very close to overbought territory.
Meaning it's gone up too far, too fast, potentially.
Kind of like stretching a rubber band really tight. It's strong, but it's vulnerable to snapping back, even if just for a short-term pullback as people take profits.
Okay, so summing this all up, we've got incredible company news, analysts are cheering, the market sentiment is off the charts bullish, technicals are strong.
But valuation models are screaming caution, the stock looks technically stretched, and we have that wider economic worry about consumer confidence hanging overhead.
So, pulling it all together from our research, what's the strategic outlook? Where do we land?
We're landing on cautiously bullish. You just can't ignore the sheer force of that company news and market momentum right now. But those risks are real. To recap, 1, technically overbought. 2, fundamental valuation says it's too expensive. 3, those broader economic headwinds are blowing.
Got it. So for anyone watching this closely over the next few days, what are the key price levels? The battleground.
Keep a very close eye on $200. That needs to hold. If the bulls defend $200 and make it the new floor, then the path seems open towards, say, $215, maybe even $220.
And the danger zone. Where does the bullish idea break down?
That would be $180. If it breaks below $180, that's where a lot of the protective put options are clustered. That's kind of the invalidation level for this current bullish run, you could say.
So it sounds like you're riding a rocket ship.
Yeah, a powerful one, but maybe one painted with bubble wrap. It's flying high on future promises, maybe less so on current gravity. The risk isn't really the tech failing, it's that the price might have just gotten way ahead of itself, even with optimistic growth.
A rocket ship with bubble wrap, like that. Okay, that's all for this episode. Remember, this podcast is for informational purposes only and isn't financial advice. Do your own research or consult with qualified financial advisors before making any investments. Thanks for tuning in. Catch you in the next episode.